Hi, I'm Catherine from Richmond, Virginia, and welcome to Personal Qualified Retirement Plans. A retirement plan can either be qualified or non-qualified. A qualified plan has to be approved by the IRS, and it gets special tax advantages. In this section, we're going to talk about the Personal Qualified Retirement Plan, which is the Individual Retirement Account, better known as the IRA. An IRA can be either a traditional IRA or a Roth IRA, named for a senator of the same name. Now, the traditional and the Roth IRAs have many features in common. First of all, to contribute to either IRA, a worker must have earned income. Earned income comes from salaries, commissions, wages, tips, but not dividends and not interest. Those are not considered to be earned income. There's also no minimum age for opening up an IRA. As long as a child has earned income, they can open up an IRA. In fact, my daughter has been serving at weddings since she was 15 years old, and every year she has fully funded her IRA. Well, what do I mean by fully funding? There actually is a contribution limit per year. And now that limit is 100% of earned income or a specific dollar limit, whichever is lower. In her case, she makes about $1,500 a summer serving at weddings, so she is limited to contributing $1,500 for that year into her IRA. In fact, if she put in too much money, there would be a penalty. There is a 6% penalty on excess contributions until they are taken back out. Now, there are other features that are common to the traditional and to the Roth IRA. For example, once a worker turns age 50, they get to make catch-up contributions into their IRA. And that means they can just put in some extra money because they're getting closer to retirement. And any worker can make the contribution into their IRA up until April 15th of the following year. So if I'm doing my taxes and realize I should have funded my IRA or put more money into my IRA, I can still do that as long as I specify that that is a prior year contribution. There's also a spousal IRA. If a married couple has only one income earner, they can still, the husband and wife each, still fund their IRAs. Now, that's not a joint IRA. There's no such thing as a joint IRA. It's an individual retirement account, so they each have to have their own accounts. But in the years when my kids were little and I took some time off and didn't have any earned income, I could still fund my IRA because my husband had that earned income. Now, I find that IRAs are very misunderstood, and people are always asking, what's the rate of return on an IRA? Well, what they don't understand is that when a worker opens an IRA, they get to choose their investment. They could choose to put that investment into a CD at the bank, into a money market or a mutual fund, stocks or bonds, even into annuities. They just can't put that money into life insurance. Once they choose that investment, they just check off the box that says, I want to make this an IRA. And that's like saying, Scotty, engage the force field, because this force field comes out and protects their investment from taxes. That's great because all the dividends and the interest that are earned can be reinvested into the account so that they can earn more dividends and interest, and it can compound and grow that much faster all the way up till retirement. Now, that investment is supposed to be for retirement, so there is a penalty if a worker takes the money out too early. If they take a distribution from the account before age 59 and a half, there would be a 10% penalty on that early distribution. Now, there are some times when money can be taken out of the IRA without a penalty. Those are the exceptions to the penalty. For example, death or disability of the worker would be an exception where money could be taken out of the IRA without a penalty. Also, to use the money as a down payment for a first-time home purchase, there wouldn't be any penalty. To pay qualified expenses for post-secondary education, money could be taken out of the account to pay for college or a trade school, anything after high school, and there would be no penalty. Also, a worker could take money out in a series of equal payments over their lifetime, and there would be no penalty, because that implies that it is being used as a retirement account. And finally, distributions could be made to pay for catastrophic medical expenses without having to pay a penalty. And those are expenses that are in excess of 7.5% of that worker's adjusted gross income. So it's nice that there are some times that money can be taken out of the IRA without a penalty. In fact, this year when she was making her contribution, my daughter said to me, "Am I really giving this money up until I retire?" Well, ideally, yes. Ideally, that money still will be in there when she retires. However, if she does need the money as a down payment for her first home, she could take that out without a penalty. Or since she's starting medical school in the fall, she could take money out of the IRA and use it to pay for those qualified expenses for post-secondary education. And that made it a little bit more palatable to be putting that money away. Now, those are features that are common to both the traditional and to the Roth IRA. What's the difference between a traditional and a Roth IRA? Well, contributions to a traditional IRA are always made with before tax money. In other words, those contributions to the IRA can be subtracted from the worker's current income if they are not a current active participant in their employer's qualified plan. If that's the case, those contributions can be actually subtracted from their current income. So that means that money has not yet been taxed. It can go into the IRA and grow tax deferred. And that means that neither the contribution nor the earnings have ever been taxed. When the worker eventually takes that money out at retirement, it's all going to be taxable, both the contribution and the interest. But that is why that the IRS requires with the traditional IRA that distributions begin by age 70 and a half. If those distributions don't begin and the worker doesn't take out the required minimum distribution, the penalty is actually going to be 50% of what the IRS says needs to be coming out because they want to be able to get those tax dollars. Now, that's different from a Roth IRA. In a Roth IRA, contributions are always made with after-tax dollars. They can never be deducted from current income. However, as long as the worker has reached age 59 and a half and the Roth account has been open for at least 5 years, distributions from a Roth IRA are tax-free. Now, that is a great tax advantage. The IRS doesn't even require that minimum distributions begin at age 70 and a half because they're not going to get any taxes. Now, a worker can have both a traditional IRA and a Roth IRA. However, that yearly contribution limit still applies. They can still only contribute 100% of their earned income or that specific dollar amount, whichever is less, into a combination of both of those accounts. The other thing is that money in a traditional IRA can be converted to a Roth IRA. But you've got to remember that the money in the traditional IRA is before tax money. The money in the Roth IRA is after-tax money. So that means that in order to convert from a traditional to a Roth IRA, the worker would have to pay taxes on the money that they convert. So that's the difference between a traditional and a Roth IRA. I hope that this section has helped you understand the benefits of an individual retirement account and the differences between a traditional and a Roth IRA.